There are several changes to the superannuation limits effective from 1st of July 2025. In this video, we'll cover these important changes to help you plan your contributions and retirement more effectively. Number 1. Superannuation Guarantee Contribution. The Superannuation Guarantee Contribution, or SG contribution, is a compulsory amount your employer must contribute to your super. The superannuation guarantee rate has reached its legislated target of 12% per annum on 1st of July 2025 for the first time. No further increases are currently scheduled. From 1st of July 2025, it increases from the previous rate of 11.5% to the new rate of 12%. This means if you earn, say, $120,000 per annum, your employer will contribute $14,400 to your super in FY26, an increase from $13,800 in FY25. For some of you, this warrants a review of your contribution strategy, and it might be urgent if you have an existing salary sacrifice arrangement in place. Number 2. Maximum super contribution base. Did you know that the 12% superannuation guarantee rate only applies to one's earnings up to a certain limit? This limit is called the maximum super contribution base. If you earn above this limit in a quarter, your employer isn't required to pay SG contributions on the excess for that quarter. From 1st of July 2025, the maximum super contribution base is reduced to $62,500 per quarter. This change helps prevent high-income earners from unintentionally exceeding their concessional contribution cap due to the higher super guarantee rate now in place. If you earn a stable income that falls under the quarterly cap, chances are you don't need to worry about this. However, if you're on a high or variable income, I've linked a great article in the description box to help you learn more. Number 3. Super contribution on government-funded parental leave pay. Starting from 1st of July 2025, eligible parents and carers of a child born or adopted on or after 1st of July 2025 who receive government-funded parental leave pay will also receive what's called the Paid Parental Leave Superannuation Contribution. This contribution will be paid as an annual lump sum, and it will include 12% of the total parental leave pay for the financial year and an interest component to compensate for the delay in payment and foregone investment returns. The ATO, not the employer, will be responsible for making the payment, and it will be paid directly into the parent's nominated super fund. This is a welcome change for new parents. I'll leave a link with more details in the description box down below. Number 4. Concessional Contribution Cap. Concessional contributions are contributions made to your super that are taxed at 15% inside your super, which is usually lower than most people's marginal tax rate. Concessional contributions include employer contributions, salary sacrifice contributions, and personal deductible contributions. The combined amount of these contributions counts towards what's called the Concessional Contribution Cap, which sets the maximum amount that can be contributed as pre-tax concessional contributions in any one financial year. The general concessional contribution cap remains unchanged from 1st of July 2025, staying at $30,000 for the 2025-26 financial year. But this is just the general cap. Your personal concessional contribution limit might be higher depending on the next rule. Number 5. Carry forward concessional contribution. If your total super balance is less than $500,000 on 30th of June of the previous financial year, you can contribute more than the general concessional contribution cap by using unused cap amounts from up to 5 previous financial years. This means that if your total super balance on 30th of June 2025 was less than $500,000, then in FY26, you can contribute more than $30,000 by using any unused concessional contribution cap from FY21 to FY25. Unused cap amounts are applied automatically once you exceed your current year's general cap of $30,000. From there, the oldest available unused cap amounts are carried forward first. In an extreme scenario where someone is eligible and hasn't made any super contributions since FY21, they could make a total of $167,500 in personal contributions in FY26 and claim a tax deduction. That's 6 years worth of concessional contribution caps, 5 years of unused caps plus the current year's cap. For comparison, the maximum in FY25 was $162,500. Depending on individual circumstances, even a less extreme application of this strategy can save a lot of tax for someone with a one-off high-income event, such as selling an investment property. A good way to check your unused concessional contribution cap and total super balance is through MyGov ATO service. Before we move on to other super-related changes, I want to give you a bonus tip. The effective tax-free threshold for FY26 is $22,575. This amount remains unchanged from FY25 and it applies to most Australians who are not eligible for the seniors and pensioners tax offset. If you are planning to use concessional contributions to reduce your taxable income to the tax-free threshold, make sure not to aim too low. Many still mistakenly aim for the headline threshold of $18,200. For more on the effective tax-free threshold, check out that video over there. If you like this video so far, don't forget to like and subscribe. Now let's move on to non-concessional contributions. These are contributions made to your super with after-tax money. What I mean by after-tax money is money that you already paid personal income tax on, like wages from your employer that are now sitting in your personal bank account. You don't get taxed again on non-concessional contributions inside super, and you cannot claim a tax deduction for them. Each year, there is a limit to the non-concessional contributions you can make to your super. The annual limit is known as the General Non-concessional Contribution Cap, which is always 4 times the Concessional Contribution Cap. Since the Concessional Contribution Cap remains unchanged, the non-concessional cap also stays the same at $120,000 for the 2025-26 financial year. Bear in mind, to access the General Non-concessional Contribution Cap in FY26, your total super balance must be less than $2 million on 30th of June 2025. In other words, if your balance is $2 million or more on this date, you won't be able to make any non-concessional contributions for FY26. Number 7. The Bring Forward Rule. Similar to the carry-forward rules for concessional contributions, the bring-forward rules for non-concessional contributions allow you to exceed the general cap in a single financial year. But instead of using unused caps from previous years, it works by bringing forward caps from up to 2 future years. This means that in FY26, if an eligible individual's total super balance on 30th of June 2025 is under $1.76 million, they can make a one-off non-concessional contribution of $360,000 with no further non-concessional contributions allowed for the next 2 financial years. This rule can get quite complex. If you're interested, check out my dedicated video on the topic to get a full breakdown. Again, a good way to check your history with non-concessional contribution and bring forward arrangement is through MyGov ATO service. Number 8. General Transfer Balance Cap. The transfer balance cap is a lifetime limit on how much you can move from your superannuation accumulation account, where earnings are taxed at 15%, into a retirement phase income stream such as account-based pension, where earnings are tax-free. From 1st of July 2025, the general transfer balance cap increases from $1.9 million to $2 million. If you start your first retirement phase income stream in FY26, your personal transfer balance cap will match the general cap, which is $2 million. But if you have already started a retirement phase income stream in the past and haven't used up your full cap, your personal cap will go up by less than $100,000. That's because your increase is worked out by using proportional indexation. It depends on how much of your cap you have used before. This can get quite technical, so it's worth checking your personal transfer balance cap in MyGov or speaking to a financial advisor if you're unsure where you stand. Number 9. Minimum pension drawdown. For retirement income accounts such as transition to retirement pension or account-based pension, a minimum pension amount must be paid each financial year. For example, let's say John is 68 years old on 1st of July 2025. His minimum pension drawdown rate for FY26 is 5%. If his pension account balance on 1st of July 2025 is $400,000, he will need to withdraw at least 5% of that amount, which is $20,000, as a pension payment during FY26. Large super funds typically have automated systems that calculate and pay the minimum pension drawdown each year. But if you run a self-managed super fund, you need to be extra vigilant. If you don't meet the minimum pension drawdown requirement, your pension could lose its tax-free retirement phase status. So double-check your calculation and adjust your payments if needed. Number 10, the defined benefit income cap. From 1st of July 2025, the defined benefit income cap increases from $118,750 to $125,000. Since this only affects a small percentage of Australians, I won't go into the details here. I have a dedicated video on this topic. If you already have or will receive a defined benefit income stream, be sure to check it out. Number 11, government co-contribution. The government co-contribution is a scheme where the Australian government contributes to your super if you meet certain eligibility criteria. In FY26, the maximum benefit is $500 if you make a non-concessional contribution of $1,000 or more, and your income is under $47,488, known as a lower income threshold. The exact co-contribution amount depends on how much you contribute and your income. The government matches contributions at a rate of 50%. The maximum co-contribution of $500 gradually decreases and disappears when your income reaches $62,488, known as a higher income threshold or cutoff point. For FY26, both the lower and upper income thresholds have increased, meaning more people will benefit from the government co-contribution. You can use the Super Co-contribution Calculator on the ATO's website to estimate your co-contribution entitlement and eligibility. Number 12, Division 296 tax. The Australian government has proposed a new tax measure known as Division 296 tax, targeting individuals with superannuation balances exceeding $3 million. If passed, this tax would add an extra 15% tax on earnings linked to the part of your super balance over $3 million. It has a proposed start date of 1 July 2025. However, as of now, the new bill to legislate the proposed Division 296 tax will not be introduced into Parliament until late July 2025. So it's still unclear if or when it will pass, what the final version will look like, and whether it will start from a new date or be backdated. I'll cover this in a dedicated video once it's officially passed, so stay tuned. Speaking of new taxes, have you heard even Trump is planning to tax Australian investors? If you have a superannuation account, you are likely to be affected. Watch this video to find out how. Thanks for watching, I'll see you over there.